Hello and welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macroeconomy to help you make better home buying decisions. The U.S. 30-year fixed rate is sitting at 6.72, which is up from the previous week's 6.67. So it's coming back up a little bit, but still hasn't jumped up too high. Last week was a little bit of a slower week, but this week it's definitely picked up. We have a good bit of inflation information that has already come out this week. A little bit more information to go, so let's get on over to the charts and check it out. Over to the U.S. 10-year yield. Now, looking at the yield, over the past few days, it looks like it is climbing up a little bit higher. I know that we had the U.S. 10-year bond auction recently, and we'll get over to the data, but that came in lower than the previous bond, which that's good news. But, yeah, over the past few days, the 10-year yield has been climbing, but it's really not too much. I mean, we've gone from down here, like a 4.182 to a high of 4.494, still lower than in May, which was at 4.633 at its peak. So probably nothing to be too concerned about. The U.S. stock market is doing fairly well right now. Like we say, there tends to be a relationship. This isn't always the case, but there tends to be an inverse correlation between that and the bond market. Speaking of the bond market, this is it. This blue line. So we can just see that there's been a little bit of a sell-off recently. But let's see. Yeah, I mean, I don't think it's anything too concerning with interest rates. They don't look like they're really approaching back in January how high they got. But, it's always worthwhile to keep an eye on this. So let's get over to the calendar. Last week, we didn't have too much. The 10-year bond auction happened. And let's see. So, yeah, it's just looking at the highest yield on the 10-year bond. And the U.S. 10-year yield is what we look at for interest rates. So let me see. Okay, this is monthly. So yeah, 4.36, previously 4.42, and all that tells me is just that it is coming down a little bit. People are interested in that 10-year bond, which is good news, right? If people were not interested, then the yield would continue to rise, which would not be great for mortgage interest rates. So this week on Tuesday, we had CPI data, and CPI is the Consumer Price Index, and it's essentially a basket of goods that helps measure inflation. The Federal Reserve prefers to use the PCE, but CPI is good to keep an eye on. Core versus non-core, this is just cores excluding volatile goods such as food and energy. So CPI was up, but it did not exceed expectations. This is really good news. I guess it looks like the year over year did. So 2.7% is the year over year inflation for this basket of goods, the Consumer Price Index. And previously is 2.4. So inflation is still ticking up while the job market is not deteriorating, which gives the Federal Reserve, we have to wait and see what PCE is looking like. And we're kind of getting a little bit of conflicting data, and I'll get into that in a second. But the Federal Reserve is holding off on any interest rate cuts. And that's the federal funds reserve rate. That's not necessarily mortgage interest rates. However, those probably will be impacted, but this is not a direct reflection. Whenever they cut rates, that's not a direct rate cut for mortgage interest rates. That's a federal funds reserve rate. So essentially, borrowing money from banks and whatnot. And, any kind of interest rate that you're getting at your bank, like if you are looking at like a high yield savings account, whatever they're willing to give you in interest, if rate cuts happen, then they will lower their interest rate that they're willing to pay you to hold your money in their establishment. Anyway, so yeah, it wasn't bad month over month, but year over year, inflation still is not coming down. There's a target of around 2% that is healthy for inflation, and that's where the Fed prefers to have inflation at. So we are not coming down in that. Year over year, we are up. Now, if we look at PPI, this is on the producer side. So this is consumer goods, and this is manufacturing goods. This PPI, this is the producer price index. And this is not saying that there was no inflation, but the inflation did not change month over month for core or non-core. And that's why I'm saying a little bit of conflicting data. This might be because of, I think the tariff price should be in here, and either tariffs weren't having the inflationary impact that we thought, or it could be the case that manufacturers just bought plenty of supply ahead of time. And maybe that's what it is. I'm not completely sure, but regardless, this was a beat, and this was Wednesday, July 16th, which is this morning as of this recording. So we have a 0% on the month over month. So that's really good news. So we'll see. We have conflicting data. That's why we have to see what PCE looks like. That's the personal consumer expenditure, and that is what the Fed prefers to look at. Let's see, anything else? We have core retail sales. This is just interesting to look at. It just is good to see retail spending habits, looking at how consumers are spending money. Obviously, if people are willing to spend money, they're probably willing to go out and buy houses. So not directly related, but maybe like a little clue as to, how the housing market is doing. Unemployment has been fairly solid, so it'd be good to see what unemployment is looking like. We also have housing starts and building permits, which this is always good to look at. See our houses being built. And we have the University of Michigan consumer sentiment. This usually impacts the market. So Friday, this is something to look out for. They really have not been great. You can see previously, the inflation expectations, the previous survey was a 5% for inflation. So these typically don't have very positive outlooks for the economic future. But if things do look better on the University of Michigan expectations on these surveys, then that could be really good for the market too. So that's something to keep an eye out for. Like I said, with the 30-year fixed, we are sitting at a 6.72 as of July 10th. And that is up from the previous week's 6.67. I would expect this to climb a little bit, but we have to wait and see, because I believe last week I thought that this was going to be down a little bit. I'd have to go back and look at the tapes. But anyway, I would expect this to be up a little bit this week. But overall, we are seeing a trend. This is 2023, so maybe you don't want to look all the way back there, but a little bit of a trend, right? 2024 to 2025. Like, the peaks aren't getting as high. And that's on a little bit of a longer time scale. This isn't a super scientific. It's really just an eyeballing of this. But that's all I got for you this week. So if anyone has any mortgage questions, feel free to reach out to Mortgages by Linda at 877-TEAM-MBL, or visit us at www.mortgagesbylinda.com. All right, everybody, have a great and safe week. Bye.